else do we have going on? We're looking at all sorts of different metrics, and they're all bad. Credit card debt has officially broken pandemic levels. Credit card debt for Americans is now at the highest level it's been since God knows how far back we have to go. This is 2008, and it's not even close. So, yeah, that's not good when the United States consumer currently has the highest credit card debt we have seen in I don't know how long, probably maybe ever. This might be the highest ever as far as I can see from the chart. So Google search volume for help with my mortgage is at the highest levels since the 2008 financial crisis. That's not good. We're noticing a lot of these metrics are really, really bad. A lot of these metrics are all matching what they looked like in the global financial crisis and the dot-com bubble. It's pretty wild how exact, if not worse, they are than those situations. Credit card account delinquencies by 90 plus days have jumped to 13.1%, the highest level in 15 years, which goes back to the global financial crisis and closing to the highest level ever. That's not good. Oh, I'll explain this one because this one's a little bit more nuanced to understand. Stock market closing in on its highest Shiller PE. This is price to earnings ratio. I'll explain how this works. In history, now only slightly less than during the dot-com bubble. You can see if you go all the way back. Yeah, there's the this goes back to 1930, right? So the dot-com bubble, which is one of the biggest crashes ever, we're nearing that, and this is also higher than all the way back to the Great Depression. This is the price to earnings index. So what this means is what a stock is worth compared to what the actual earnings of the company are producing. So the higher this ratio gets, the worse it is. So keep in mind, like if a company has a crazy high stock price, Tesla, for example, but their earnings are really, really low and shitty, that's not a good investment, right? Because the stock market's price doesn't reflect what the company is actually worth. And so what the ratios are showing here is that the stock market, the entire stock market, is worth way more than what any of these companies' actual earnings are showing, which means it's untethered from reality. The stock market is no longer in reality. We are back to dot-com bubble scenarios. And the dot-com bubble, for those of you who aren't like tied in on what that was, the reason why that spiraled out of control was essentially when the internet started booming, investors started investing in basically any company that had .com behind it. So there was hundreds and hundreds of companies that got tons of investments into it, tons of money pouring in, and they ended up doing nothing. The websites just flopped, and that's what actually caused that massive crash. So again, all of these companies that basically aren't producing anything, but their prices are crazy high, that's what we're seeing in the current market. So what that means is the current stock market is not realistic.